All right, ladies and gentlemen, Aaron Fragnito here at People's Capital Group. We're going to get started. I see everyone jumping on here. We're going to get started in just a minute or so. We're doing a live presentation tonight about a 27-unit rental property in Paterson, New Jersey. I'm sorry, Rahway, New Jersey. Also buying a property in Paterson in a couple of weeks. So this property is a very interesting opportunity. We're going to go over it today in depth. And this will be a live presentation about how we're going to structure this private offering, the benefits our investors will experience investing and participating in this offering, and how we've been doing this for about 10 years, and our process and our mindset and our track record of success in New Jersey and Southern Vermont as well here at People's Capital Group, and just how we make it work for our private investors who have been reinvesting with us for years, and explain how that process works and how to get qualified to do that, and if this is investment that meets your goals. So we're live on Facebook here. Maybe you found us on social media. Maybe you've found us on our real estate investment group of over 4,000 members. Or maybe you just have been following us for a number of years here and just met us through the industry. We've been buying and selling properties in New Jersey for over 10 years, Seth Martinez and I. So we know a lot of different investors and we've connected with a lot of people. We're going to break into this property here located at 190-200 West Milton Ave in Rahway, New Jersey. Great location here, just a couple blocks to the train station. Nice, easy value add opportunity. And we'll break into that tonight. So this is presented by People's Capital Group. We're located out of Berkeley Heights, New Jersey. Again, maybe you found us at one of our webinars. We do webinars almost every month on how to invest passively in real estate, maybe how to self-direct your IRA in real estate. That's a presentation I give about 6 times a year now. Or maybe come to one of our networking events. Before the COVID, we had lots of networking events. Now we do them online. But we've for years entertained and educated investors live and in person. We don't sell coaching, we don't sell education. We focus on presenting off-market, good investment opportunities to our passive investor group of qualified investors. And they enjoy what we offer them and earn returns from those investments. And we help people invest in real estate. This particular property is located in Rahway, New Jersey. Maybe you know about Rahway. It's a really up and coming area. It's got a nice arts center. For over the last 10 years, Rahway's really come alive. It's an easy commute to New York City, only 17 miles to New York City, great downtown area. And we're going to break into this offering here. We're going to talk about Rahway, some of the benefits there, some of the benefits of overall just investing in North Jersey, being 45 minutes to Manhattan. A train ride to Manhattan is really a nice benefit in this market that holds our demand year over year. Real quick here, not a solicitation for funds. Quick disclaimer: this is not tax advice or legal advice. We're going to go over the due diligence we've completed thus far on this property. This is not a solicitation to invest. You do have to go through a qualification process. Maybe you've already gone through that and you're one of our current investors and you're just reviewing this offering to see if it's a fit for your investment goals, or maybe you're just getting started investing with us and you're learning more about our team. If you feel like this is a fit, you do want to go to peoplescapitalgroup.com and schedule that discovery call, fill out a qualification form to review this offering on your own time and your own terms. And once you get qualified, we can send you this offering and future offerings to review. But we're going to kind of breeze through this right now. This will be about a 30 to 45 minute presentation. If there's questions as we go along, I see more people are jumping on here. That's good to see. Please type them in the Q&A. All right, so if you have any questions, put them in the Q&A. I'm going to answer all questions at the end here, and we're going to be able to answer hopefully any of your questions about how to invest in the property itself here. And you can put your mouse over the Q&A in the Zoom and type those questions in there. As we go along as well, I'm going to be going over the details. If at any time through this presentation you feel like you're ready to get qualified, I'm going to post that. I'm going to post that here, the link to go get qualified in the chat, so that if you want to start that process, you can go right in the chat here and click that link, and that will allow you to start the qualification process as we go along with this offering. Okay, so we talked about Rahway, we talked about the disclaimer. Now let's get into a little bit about People's Capital Group. So who is People's Capital Group? So we've been doing this about 10 years, Seth Martinez and I, working with passive investors, helping people invest in real estate so they don't have to do the heavy lifting, they don't have to do day-to-day management, and also do all the work behind the scenes to find the opportunity. So we've created a nice turnkey system where everyday people who don't have any real estate experience, or maybe do have some real estate experience, but are tired of all the shenanigans of being a landlord, are ready to invest passively with professionals that do all the work. We have a management company in place, in-house management. We've been doing this long enough so we get a lot of good deals, and we can bring those well-vetted opportunities to our group. And they, of course, don't have to do all the heavy lifting behind the scenes. That's our job, to make sure they get those passive returns from the property. So we have combined 25 years experience with our company here, and Seth and I have both been helping people invest in North Jersey for over the last 10 years. Our management company is really a repositioning company. We'll talk about that a little bit in this presentation. And here's another picture of downtown Rahway with shops and restaurants, a booming art scene. So we really like Rahway. I've been investing in Rahway for years. It's been a really up and coming town, and this is a very nice location. Here's the summary of the offering. So we have 27 rental units here. The property consists of 2 buildings. One is technically a rooming house with 17 studios, but it actually is operated as an apartment building. And it's also zone property that can be operated as either or. So we are going to actually be turning those studios into nicer units, putting in a kitchenette in those studios. And then the 10 one-bedroom apartments, we're going to be improving those cosmetically as well. So the value add on this is to improve the units cosmetically, especially the studios, because putting a kitchenette in a studio makes a big difference. Now you have a kitchen. Now you have a commuter that might enjoy that unit. Now you can get a lot more for that unit as a monthly rate, and that's going to allow you to, of course, increase the rent roll on this property. And that is the whole goal, is to lower our expenses and increase the income on the property to allow us to reposition the property. And we do that by investing some capital into the property and improving it in cosmetic ways. We're not buying buildings where we knock them down. These are not gut renovations. We focus on more so, the technical term is lipstick on a pig, where we really take these properties that are not performing and make them into performing assets. Maybe there's mismanaged tenants. The leases have not been renegotiated in years, deferred maintenance. And here's an example of, studios that don't have kitchenettes, where for the small price of a couple $1,000s, you can get a kitchenette put in. Now, all of a sudden, those studios become much more desirable. It also has parking for 28 cars. That's very good as well. Parking is always hard, especially near the train station in those areas. So the major value add is the average rents for 1 bedroom is $1,080, and the studios $742. So collectively, the rents are about $250 below market rent per unit. Okay, that's a big difference. That's about 20 to 30% below market value. So the rents are just a little bit above 30% below market value. So there's really room to increase the rents, especially if we improve the units as well. Then the rent can go even higher. So the idea here is also that's close to the train station. We're going to try to work as much as we can with the current tenant base, but we're also going to offer cash to keys for certain tenants. Tenants that aren't cooperating and not paying rent, of course, will be evicted, but we are going to try to work with the current tenant base as much as we can and improve their lenient units and renegotiate the leases over time. And for those tenants that aren't going to cooperate, then we'll work out other scenarios with them. So there's lots of other options for us as well. It's within walking distance to shops and the art scene in downtown Rahway. And ownership in a flourishing real estate sales market just 17 miles outside New York City. Our targeted annualized cash-on-cash returns about 11% plus. There's a couple different tiers we'll go over. The more you invest, the better your tier is, the better your return is. So we reward a larger investment. We'll go over that towards the middle of the presentation. And the length of the investment is 4 to 5 years with the option to extend. So Seth and I have a long-term view on real estate. See, we plan on buying these properties, repositioning them, improving them, getting them to become cash flow machines, and then refinancing over time. We'll talk about the cash out refinance in a second. I'll really break that down, how that works. But we don't really plan on selling the building anytime soon. We're a lot of syndications. That's what we are, real estate syndication, a real estate syndicate, where we pool capital together and buy a bigger building. A lot of real estate syndicates, they end up selling the building 5 years, 7 years down the road. And that's fine. You can do very well with that and make a good profit. The problem with that is then you get nailed on taxes. So we like to open our investments up to our investors with taxes in mind, right? A lot of the reasons people get into real estate over the stock market is because real estate has better tax benefits. You can get tax depreciation right off your cash flow, where stocks don't offer tax depreciation. So because of that, we look at real estate as a tax strategy, and that's why we take a lot of tax depreciation. Sometimes we'll front load that through a cross segregation study. But the bottom line is we can use that tax depreciation so our investors can write off their cash flow, so they're not paying income tax on the cash flow they're earning. And then when we go do our refinance, our investors would expect a large lump sum of capital, maybe a 40 or 50% return on their investment at the refinance every 4 to 5 years. Now, if you were to collect a 40 or 50% return on your investment, say in the stock market, or if you were to sell a building and get a 40 or 50% return on your investment, you would have to pay the IRS income tax. Now, what we do is we do a cash out refinance. So Seth and I will get the property to appraise at a higher price than what we bought the property for, after we renovate it and get it cash flowing and banging on all cylinders and really performing as best it can. And then we'll go to the bank once we have a history of performance, and we'll go and we'll get a new mortgage amount, a safe mortgage amount. The bank's not going to let us take out more of a loan than the property can handle. And our tenants are going to pay that mortgage down for years, as the property is professionally managed with our in-house management company. But once we take out that larger mortgage amount, we pay off our older mortgage amount, we have cash left over in between. So that's called a cash out refinance. So by doing the cash out refinance, we're able to take a lump sum of capital off the table, split it up with our investor group, and really do very well for our investors there. And that's a scenario where if they choose not to exit, that's tax-free money. The reason that's tax-free money is because it's debt. It's debt that's going to be paid back by our tenants for years to come. Often Seth and I are personally guaranteeing that debt, so the investors don't have to. And the investors don't personally guarantee the debt. So it's just debt to the company. But it's good debt. It's low interest debt that will be paid down by the property itself. And that allows us to take capital off the table to harvest equity growth that we've forced into the property over time, and harvest that equity growth and pay that out to our investors and ourselves. And that's how we get paid. And that's how our investors get paid. And that is the cash out refinance strategy. And that's a great tax strategy, because as long as you don't sell the property, you actually don't owe income tax on that. You can defer all the taxes through a 1031 tax deference, which is really a whole other presentation in itself. But that's what we plan on doing with the properties, is 1031ing into bigger properties over time. You don't have to stick with us for 5, 10, 15, 20 years. You can, as we plan to 1031 sell the property, trade into a bigger property, defer all taxes along the way. That's a great tax tool. That's a great real estate tax tool that really is mostly used in real estate. And that 1031 tax deference is our ultimate exit strategy to move into a bigger property. So ideally, you'll make back about half your investment in the first refinance, about the second half by the second refinance by year 8 or so. And then, of course, we'll refinance again around year 12, and they plan to sell through a 1031 tax deference by year 15 or so, as we try to exhaust all the tax depreciation, and then we'll trade into a bigger building. And of course, a bigger building is going to produce more cash flow, restart the tax depreciation, and of course, allow for larger equity growth over time. So we have a very long-term view of real estate. We invite you along with that long-term view to put your kids through college and pay for those things in life that are really important to our friends and our family and ourselves. But you also have the option to exit every 4 years as well, each refinance. So we allow that flexibility for our investors, and that's very important to them and to us as well, to make a win-win for everyone. I see a few questions popping up. That's good. That hopefully I'm not explaining things too confusing here. And so I will answer all questions at the end. If you have any issues hearing me or seeing me, of course, let me know that as well. Okay, so the length of the investment is 4 to 5 years. The minimum investment is $30,000. The maximum investment is $450,000. Now, remember, while we own that property before the cash out refinance, the building's also producing cash flow, and that cash flow gets paid out quarterly. So our investors should enjoy quarterly cash flow checks based on positive cash flow once we get the building up and running, which does take about a year or two sometimes, depending on the project. And then, of course, tax depreciation at the end of the year through a K-1 tax form that allows them to write off that cash flow they're earning every quarter. And then, of course, the cash out refinance is the big liquidity event. That's going to be about a 40 to 50% return on your investment, and that's going to be every 4 years or so. So that is a maturity investment there. But of course, the investors enjoy cash flow every quarter as we get to that maturity event. All right, here's a couple of pictures of the property. It's 2 buildings, 1 lot, 2 buildings, lots of parking. And here's the founders. So that's me, Aaron Fragnito. I started as a realtor in this business. Seth and I have done over 250 real estate transactions together. We've wholesaled real estate. We've fixed and flipped real estate. We've bought and sold properties. We have about a $17-18 million portfolio right now, about 116 units. We've sold apartment buildings. We've bought them. We raised capital from a good group of investors. And about 90% of our investors reinvest over time. And that's really important to understand that. Right? Whenever you're talking to an operator or syndicator, or whatever the group is, whether they're buying billion-dollar properties or $3 million properties, do their investors reinvest over time? That's the biggest question. Is their current investor group satisfied? Right? Are they reinvesting? And we find that about 90% of our investors do reinvest over time. And when given the option to exit or move forward on another term of the investment, they tend to continue in the investment unless there's a personal situation where they would need the cash back. So within the past, we've had good historical performance, being about 10% or so above targets, 10 to 15% above targets. So we generally are able to achieve our targets over time, if not exceed those targets over time. There's our headquarters, People's Capital Group headquarters. And we're just going to talk about the quality of life here to our real estate investors. We really try to make a nice, easy experience for our investors. We try to make our financials very in-depth, very accurate, very quickly sent to you through email at the end of each quarter. Same with the cash flow checks. We try to get those out in a timely manner. I send out monthly updates. These are in-depth monthly updates. A lot of times they have pictures or videos and other documents, and these are going to tell you what's going on with the property. The good, the bad, and the ugly, the challenges we're having, the success we're having, things that are going as planned, things that are going maybe not quite as planned, things that are going better as planned. So our investors learn a lot through this process. We call it the learn and earn. We don't sell coaching. We don't sell education. I'm not your guru. But the bottom line is I really try to be as transparent as possible. Our investors are invested in one project specifically. Many of them are in many projects, but each fund is its own project and its own LLC. So therefore, you get updates on a specific property, you follow the property along. Obviously, the financials correlate with that as well. And our investors really learn a lot about how to reposition apartment buildings, how to be an expert real estate investor. And of course, tax time is easy. We have all the tax filing done by our professional CPA bookkeeping company, which is a whole third-party company that does all the bookkeeping and tax filing for our company. So we have a whole third-party company that does all that. And that makes sure your tax documents are sent in a timely manner. Those K-1 documents are filed properly. All those tax documents are filed properly. And of course, the bookkeeping is done in a timely manner, properly and effectively, so that we pay as little taxes as possibly. And the building, that's of course, all part of property management, right? We've hired other property management companies. We were very disappointed by them. We figured out that to do something right, sometimes you have to do it yourself. And we developed our own property management company, and that's our competitive edge over many other syndications. So at the end of the day, our investors enjoy more quality time with their family, not having to deal with the headaches of being a landlord, better returns by being invested in larger buildings and not having to just be stuck with small buildings like duplexes and triplexes, which don't cash flow as well as larger apartment buildings. And of course, we have numbers of insurances for the management company to property insurance. So we're very well insured, life insurance. So we have lots of levels of protection for the building itself and the companies that manage it and own it. Speaking of which, here's our property management company, PCG Property Management. So this is a very important part of the presentation because this is what sets us apart from other syndicators. See, most syndications raise capital in New York and New Jersey or California or Texas, where there's a lot of wealth, in Florida, and they move it into assets out of state. And they move into those assets because those are growth markets they're looking for, but they're forced to hire third-party management companies. Now, we've hired third-party management companies before. One stole money from us. Another one completely overpromised and underdelivered. A third just really, we felt like a number on a screen. We need to buy these buildings, renegotiate leases, renovate the units for the lowest possible price, get it done very quickly, figure out how to make more forms of income on the property, maybe through laundry or storage or parking, figure out how to lower our expenses, remove the people that are not cooperating. This is a lot of work. Lease the new units for top dollar to the best tenants we can find. If you really go to a management company, you're like, I need you to do all that and for a discounted management fee and reposition my apartment building, they'll be like, no, that's not what we do. We collect a check when it's ready, and we call a plumber when a pipe leaks, and that's what a management company does. We want to reposition these buildings, take a zero, make it a hero, move these properties into performing assets. A lot of times we buy them for a good price because they're not performing, right? No one's going to sell you your building for a discounted price if it's doing really well and you executed all the right things to get there, right? So these buildings often are non-performing, although this one's actually performing decently. There's a couple delinquent tenants, but it's really actually not that bad as performance, but it needs some cosmetic value add. And the rents are 30% below market value. So we really focus on customer relations with our service providers, with our tenants, right? A happy tenant equals a happy investor. So the first thing we do is make sure that we're respecting our tenants when we're negotiating a cash for keys or a higher lease amount or a renovation strategy with the property. So we come into these buildings and they're often mismanaged. Maybe the tenants are angry at the last landlord or the last management company didn't return their calls. So we need to come in and explain we are a better management company. We're going to improve the building. We're going to improve your quality of life. It's going to be nicer to live here. It's going to smell better. It's going to look better. You're going to feel safe raising your family here. You feel comfortable bringing your friends here. But you're going to also have to pay fair market value for that quality of life. And a lot of times tenants are happy to pay a little bit more for a better quality of life. They were looking for that, right? They're okay with that trade-off. And that's what we work out with our tenants. And we know that a happy tenant equals a happy investor. We decrease our expenses. We increase our forms of income from the property. We get it performing as best as possible, so it's producing strong cash flow to our investors. Here's a picture of the electrical units, all separate electrical for that one building there. And then we have our investment details here. Okay. So let's break into some of the investment details, the opportunity highlights. So we talked about the significant value add for the investment with long-term gains. We do feel the property values below, the property purchase price below market value right now. So we're buying with a little bit of equity off the bat. And then we'll go ahead and we'll bring the rents up to market value over the next 2 years or so as we renovate the units, renegotiate leases. And again, we feel it's 30% below market value. 30% is a very large number. There's not a lot of apartment buildings in 2 blocks to the New Jersey Transit train station with rents 30% below market value. Trust me, we look at hundreds of them a month. So these are diamonds in the rough. We're looking at moving the rent from about $280,000, the rent roll right now, to about $360,000 a year. We talked about Rahway and the strong rental community there. A lot of renters in Rahway, a lot of commuters in Rahway. Just a high demand location, very up and coming, 2 blocks to the train station, and a 13 to 16% targeted internal rate of return. Now, we're very conservative when it comes to our targets. We really try to underpromise and overdeliver. That's why people reinvest with us, because we tell you we're going to get 13 to 16 and we hit an 18. So it's all about underpromising, over-delivering. We try to set the bar at an attainable level. We assume, for example, expenses are going to go up 50 cents for every dollar we increase rent. Right? We just assume that. That's not really always accurate. We'll come in and be able to increase rent by a large amount pretty quickly. Expenses aren't really going to shoot up by 50% of that, but let's just assume that. Let's just be cautious, right? Let's be overly conservative. So we assume things are kind of worse than they already are. We assume conservative things that don't usually happen, but we want to have that room there so that we put these targets on the board. We don't only achieve them, but we do better than them. Right? Because we want to do better than these targets. I don't want to achieve our targets. I want to do better. Seth and I are always about improving, always about doing better. And I think our investors see that and appreciate that as well. And it's a big part of being a small business owner and a big part of growing a real estate syndicate. Here's the lobby. Nice lobby, nice ceilings, actually. They have the intended ceilings there. So not a lot of work to do to the building. Really a nice, clean building. Again, it's really about management, right? Renegotiating leases, putting kitchenettes in the studios, cleaning up the building overall. We do have some money here for some other items. I'll go through it. It's on a 3/4 acre lot, 17 studio units. That's where we put the kitchenette in. And then we have 10 one-bedroom units. Okay, we have separate electric meters for each unit and 28 parking spaces. Okay, the premises we renovate and retrofitted as follows. So we have exterior improvements. The front face, we're going to try to paint a little bit or improve it. We don't think we'll need a roof, but we want to have an allocation for that right now. We're completing a home inspection on the property by a licensed professional, so we'll know more as we go along. So landscaping, basement cleanup, laundry facilities. We're going to put laundry facilities in the basement and charge for that. That's a great way to make another form of income on the property. That goes right to the bottom line. And of course, interior improvements. We're going to put kitchenettes in 17 of the studios. We're going to put $5,000 into each of the one bedrooms over time. And we're just assuming $20,000 for the lobbies. And about a $50,000 contingency, which is quite large, but you want to have some meat on the bone. You want to have some room in the numbers, as these bigger properties do tend to have costs that aren't always foreseen before buying the property. So about a $338,000 renovation budget there overall. Here's an example of one of the studio units. Okay, you have hardwood floors, nice clean units, pretty big windows, and a heating system there. We have hot water radiator heating systems. As we were saying, located 17 miles outside of Manhattan, 2 blocks of the train station. Union County has really been growing quite an amount, and Rahway's actually was named #2 best small towns and art scene in the country by 10 Best USA Today. So Rahway's getting some awards. Really a cute little city there. It's better, it's near Elizabeth, but it's a little more desirable than Elizabeth. And here it is on the map. So you can see Rahway. There's Elizabeth. There's Newark. There's New York, Hoboken. Okay, Union. So it's really right in that stretch there to get into New York City. A lot of people are moving out of New York City. They're realizing they can live in a city like Rahway and get a 1-bedroom apartment for $1,300, where you're not going to get that in Manhattan, right? So it's more affordable to live in North Jersey than it is in the boroughs of Manhattan. So more and more people are moving out of there. The pandemic kind of accelerated that as well. Rahway tends to be like a good middle point. It's not like a completely congested city, kind of like maybe like Newark or Patterson can be considered that. It's more of a kind of suburban city outside of Elizabeth. Okay, so here's some accolades for downtown Rahway. Again, if you're a qualified investor, we can send this to you to review on your own time. If you're not qualified, you want to go to that link I put in the chat to get qualified and schedule a discovery call with the managing member of People's Capital Group. And that way we can send you this offering here to review on your own time as a PDF. Here's some information about the demographics. Okay, 27,000 people live in Rahway. Nice size, a small city. And here's a view of Rahway, New Jersey from the Manhattan skyline. So there's views of the Manhattan skyline in Rahway, although I don't think our property offers that. And of course, the value adds. We talked about the cosmetic value add. It will take about 2 to 3 years to do that. We give ourselves that space. However, we're working on a value add right now. We assumed it would take about 3 years. We were done about 2. So generally, we can hit it a little bit above target there. Although, again, we don't want to overpromise and underdeliver. So we're going to say 2 to 3 years, and I'm pretty confident we'll get that done about 18 to 24 months, ideally. That's always the goal. And of course, we will obtain a mortgage to get 75 to 80% of the purchase price of the mortgage. Seth and I will obtain that mortgage so our investors don't have to, and the investors will bring in the down payment, construction costs, and closing costs. Here's a picture of the Rahway train station sign there. We're 2 blocks of the train station. Here's a map showing us just where we are. We're next to a Wells Fargo. That's always a good sign. If you're next to a bank, that's a good sign. Banks normally don't locate themselves in bad areas. So that's a little real estate tip there. And there's our train station. All right, so we are 2.5 blocks or so there to the train station. Okay, reporting. So again, we work with a third-party CPA firm that does all the reporting, all the bookkeeping for all of our assets. Not only is that a nice separation of powers where a whole third-party company is doing the bookkeeping and the reporting and the tax filing, but that's a nice system where that's all done properly. professionally, and that's very important to our investors, that their tax documents are done effectively and quickly. Same with financials and quarterly checks and updates and things like that. You want your information easy to understand. You want your information readily available. I personally, I'm invested my IRA with some financial advisor, and every time they send me an update, I have to go through this like complex process to like open it and answer all these questions, and it's really annoying. So half the time I don't even open the update. And so we just want to make it easy for you to read our updates, easy to review the financials, easy to do business with us. We want the experience to be enjoyable, and the feedback we get from investors is that it is. Here's a picture of the parking lot from the rear, parking for 28 spaces. Parking is very important. Parking is key. Gotta love parking. That's also value add opportunity. We're not charging for parking right now. Maybe that's something we can work into the lease. Okay, that's another way to renegotiate lease amounts and get that total lease amount higher. So here's the responsibilities of People's Capital Group. So we need to secure the loan. We need to oversee the bookkeeping and accounting, and we need to oversee the entire management of the property from A to Z. Our management company is in charge of leasing, in charge of collecting rents, right? In charge of contractors. We want to make sure the contractors are using are reputable and licensed and effective. They're not, showing up 2 days a week. We want them there getting the job done. Time is money with these properties. We want to turn them over quickly so we can lease them up quickly. We want to line out the door for our vacant units. We want to have a list of qualified tenants ready to go. These are tricks of the trade to make sure you're moving these units effectively, properly for top dollar, right? When you have a list of tenants scratching to get at your units, then you can charge that top rent for your units. And that's about good marketing. That's about good branding. That's about good renovations on the property and good management and just following up in sales and leasing. So we have a good leasing team, and that having a good leasing team is a big part of running these properties the right way. Because if you put in the wrong tenant from the start, you're in big trouble. You got to put in the right tenant from the start when turning over these properties. It's all about selecting the right tenant as well. So let's talk about the responsibilities of the investors. So we only work with accredited or sophisticated investors, okay? An accredited investor is someone that earns over $200,000 a year or $300,000 with their spouse, or has a net worth of $1 million not including their primary residence. If you are not necessarily an accredited investor yet, but you have the minimum investment of $30,000 plus another $30,000 in savings, you also have some experience owning or investing in real estate. Maybe you've owned an income property before or bought your own property, and you understand the investment opportunity, meaning you've reviewed the private offering on your own time, you've filled out the qualification forms, reviewed it, you've taken a look at the asset, you understand the asset, you've had a one-on-one conversation with me, Aaron Fragnito, about the opportunity to answer all your questions. Then you would likely qualify as a sophisticated investor, and that would allow you to also participate in these investments. So we really pride ourselves on working with multi-million-dollar accredited investors that have over $1 million with us and investing with years with us. And then we pride ourselves on working with small investors that are maybe getting started, maybe a realtor that just closed a big deal and they're getting into real estate ownership now. Or maybe some of our contractors we work with, our service providers, our plumber invests with us, right? So we really pride ourselves on working with all different types of people, all different types of investors, not just the really rich and really wealthy people. We really work with everyone on the spectrum. So that, of course, there's a qualification level. Of course, you do have to have a certain financial standard to invest with us, but we try to make it easy. We try to work with beginning investors as the SEC allows us. There are restrictions on that, of course. You're not sure if you do qualify, if you're not sure if you're accredited or sophisticated, then go to peoplescapitalgroup.com. And once you fill out the application, we'll be able to figure that out a little further. Here's some rental comparables. All right. So we're looking at one bedrooms down the street going for $1,395 a month. Most of the one bedrooms on the property are going for $1,000 right now to $1,100. Here's another one bedroom, $1,450 a month. Here's another one bedroom, $1,595. Studio apartments. Here's one for $1,015. Here's one for $1,100. Here's one for $1,000. Some of these are in Roselle and Elizabeth, which really are less desirable towns. So you could argue that if studios in Elizabeth are going for $1,000 and Roselle for $1,100, well, Rahway is a more desirable town, arguably, I would say, than in Elizabeth, and probably Roselle too. Not Roselle Park, but Roselle. Yeah. So I think arguably, these comps are even below what we can get for our units. But again, we want to under promise and over deliver. So we're going to take comps that are very conservative, and that's going to allow us to hit our mark more easily and hit over our target. So here's the offering. People's Capital Group is offering 60% ownership for a total raise of about $1.3 million. And we're going to be putting together anywhere from 1 to maybe possibly 20 investors on this opportunity. We already have a number of investors that have secured their spot, and we have a number of investors that have verbally indicated what they're investing as well. So spots are already filling up on this investment very quickly. Our last offering funded in 7 days. All right, our cash on cash return is 10 to 14%. Our internal rate of return target is 13 to 16%. And here is the chart. Here are the tiers. So take a look at this very carefully. This is an important part of our presentation here. This is how the investment tiers work. Okay, the more you invest, the more of equity ownership you're rewarded. Well, of course, that's the case, but then you also get a bonus beyond that. Okay, so if someone were to invest in the top tier of 400 to 450,000, they'd have a 15% equity bonus. Okay, so 15% more of equity than you would have in the tier 2, $50,000 to $99,000. Let me actually start over, explain this a little better. Let's start with tier 1, the minimum investment of $30,000 to $49,000. Okay, let's say you made an investment of $30,000. Well, in that case, that's a minimum investment. So there is actually a penalty of 5% reduction. So let's just say, for numbers' sake, a $30,000 investment would normally get 10% ownership of the property, right? Of the LLC created to own the property. Now, since that's the smallest tier and the lowest investment, there's a small penalization for that lowest investment amount of 5%. So instead of owning a 10% ownership share, you'd own a 9.5% ownership share. Okay, that's a 5% loss of that 10%. Now, if you invested in tier 2, 50 to 99,000, there would be no change. There's no bonus, there's no deduction. Tier 3, 100,000 to 199, there's a 5% equity bonus. So a slight increase in equity of 5%. That helps you get better returns. Tier 4 of 200 to 399,000, that is going to give you a 10% bonus. So again, a little bit more of an equity bonus. So if that amount, for example, were to retain a 10% ownership of the real estate, but then you got a 10% bonus of ownership on top of that, you would then own 11%, okay? Because 10% of 10% is 1 more percent. So you would then own 11%. So that's equity bonus. And for the top tier, there's a 15% bonus, right? So then in that example, 10% ownership would be turned into 11.5% ownership. So this increase in equity ownership or this decrease in equity ownership is a small incentive to invest a larger amount, and rewards our accredited investors who are investing large amounts with us. So that is our sliding scale of returns here. That is the incentive to invest a larger amount. We also work with a lot of investors that have no problem investing in tier 1. There's still very competitive returns in tier 1. Here we're looking at an annualized cash on cash return of about 10%. In tier 1, and then in the top tier of tier 5, the annualized cash on cash return goes up to about 13%. So, a nice increase there. But all the tiers are profitable investments overall. We try to set even the lowest tier at a number that is very competitive and will beat out other competitors. So here we have a internal rate of return of about 13%, over 13% per year for the top tier, and up to over 16% for the, 13% for the lowest tier and 16% for the top tier. And let's just re-explain here what internal rate of return means. So let's break down these returns here. So first of all, let's take tier 1 here, $30,000 to $49,000 investment. So the equity growth, we're assuming about overall in our financial formula here and our financial targets, we're assuming about a 8 to 9% equity growth overall in the investment over the annualized return there. So over the first 5-year period, that'd be about 44% return on investments. That means that the refinance, you would expect about a 44% return on investment in that first tier, okay? Second tier goes up to 46, the third tier goes up to 49, and then all the way up to 53 for the final tier. So that's the cash out refinance. Now that's paid in one lump sum, right? At the refinance, at the 4-year mark. So when you break that out annually, it comes out to that annualized number. But remember, you're not getting that on an annualized basis. The equity growth is a maturity payout. It takes place at the refinance. And we're going to break that out annually just to show you then what that would come out to on an annualized basis. Okay. But again, in tier one here, the lowest tier, you're going to expect about a 44% return on your investment at the refinance. And then you have gross tax depreciation. That's going to be another 2 to 3% a year. Then you have your cash flow. That's going to be another 1 to 2% a year. Now that does sound low, but we're very, very, very conservative on our cash flow. And that's usually a number we can do better than targeted. So in this case, you're actually receiving more tax depreciation than cash flow. That means you could write off your cash flow and have extra tax depreciation left over to write off other forms of passive income. So not only does this property give you cash flow quarterly, a large lump sum upon the refinance, it also gives a tax depreciation at the end of the year, but more tax depreciation than you could even utilize on the cash flow of this property. Because remember, when you get the refinance cash, that's tax-free money. So you're not exhausting your tax depreciation on the refinance capital, right? You're only exhausting your tax depreciation on the cash flow. And according to this chart, you'll get more tax depreciation than cash flow. So that's a pretty cool thing about real estate here, that you get that tax depreciation, allows you to write off that cash flow. So that's the goal here. Then if you add up the equity growth, the tax depreciation, and the cash flow, that's going to give you your internal rate of return, which for a tier one would be around 66% for that whole 5-year period. For top tier, it'd be around 80%. So we really start to reward that top tier investment, those higher tiers as we go forward here. It can really start to pay off over time to be in a higher tier. That's why a lot of our investors do invest in the higher tiers, because quite frankly, it's a better deal. It's a better return on investment. It's a great way to boost your returns to get in that higher tier. And then of course, you have a cash on cash return. Okay, so your cash on cash return is simply your equity growth and your cash flow. It does not include your tax depreciation. So your cash on cash return for the bottom tier would be around 10 to 11% per year. For the top tier, is going to be around 13 to 14% a year. So that is our cash on cash return. That's our internal rates of return. And that is our offering there. And that's our targets for those returns for our investors. And that's what our investors would expect participating in this opportunity. Okay, let's break into the financials here. Now, I'm not going to spend too much time getting into the financials because there are limitations according to the SEC as far as how much I could talk about this and disclose. And I do want to explain how this works, how it's structured. Again, this is not a solicitation for funds. This is explaining how this works and how we're structuring this acquisition, and how our syndication operates. So we're buying this property for $2.8 million. We're going to put down 25 to 20%. We're probably actually going to get a mortgage for about 80%, but here we'll run the numbers of the 25% down. So $700,000 down, and we're going to do a construction escrow of $338,000. We broke that out earlier in the presentation. Operating reserves, $41,000. It's very important to have operating reserves of these properties. And then we have our closing cost, $113,000. Acquisition fee of $140,000, 5% of the purchase price. And we really don't have a lot of fees, Seth and I. We have two fees. We have an acquisition fee, because quite frankly, there's thousands and thousands of dollars that go into direct mail and work behind the scenes to find these deals, analyze these deals, put together the capital. It is ridiculous the amount of work to get to just this point right here to present the offering of a good property. So acquisition fee is a reimbursement for those costs to get here. That's paid at closing, right? It's a performance pay. We don't believe in just getting paid no matter what. Our management fee is a discounted property management fee. It's about 2/3 of what your average property management company will charge. So that allows us to have better cash flow for the property. So because we own the property management company, we could charge a discounted management fee, and that allows us to have more control of the asset because we own the management company, but also have more cash flow from the asset because the management company is not as expensive. Now, our management company is not where we make money. In fact, our management company is a loss leader for us because it is so expensive to manage a property the right way. I'm not talking the way a lot of management companies do it, which is just like as little resources as possible given into each customer. I'm talking about really managing a property and repositioning an apartment building. That's what our company does. It's really more of a repositioning company. So because of that, it costs a lot to do that, but we charge a discounted management fee, discounted property management fee. We do not charge an overall asset management fee like a lot of syndications do. We don't charge a 1% on the refinance or repositioning fee. So we really limit our fees to those two places, acquisition and simply the management end of it, which is a discounted fee. And that allows us to get paid and our investors get paid. We make our money through equity ownership. The investors own 60%, we'll own 40%. So we get paid and our investors get paid. We have to make sure we hit our marks, we do our job properly, we produce positive cash flow, we get the property appraised at the right price upon the refinance. And all these things have to happen properly for us to get paid. And that's important to set up that win-win structure there so that we have to perform to put food on our plate. And of course, we do a 60-40 equity split with our investors here, and we'll raise about $1.3 million for this acquisition. Here's our income and expenses. Here's our rent roll. Here's what we believe the rents could go up to, the current market rent. Now, again, as we own this property, as time goes on, rent also tends to go up. We're not even taking into account that rent's going to go up. We're just assuming we're going to be able to rent out for what market rent is right now. And we're assuming down the road, rent, of course, will go up naturally over time as well, according to the rate of inflation generally, which is pretty conservative. So we have our total income currently at $23,000 a year. So we're going to bring that up per month. We're going to bring that up to about $30,000 per month. That's about a 30% increase. We think we could do that over about 2 years. We believe about 75% of the tenants will cooperate. And we also believe that taxes and insurance and other costs are going to go up for about 60 cents here for every dollar we increase rent. So we believe, though, over the first 3 years, we can do a forced equity appreciation of 8.6%. This is not a guess. This is not a shot in the dark. This is a scientific method. This is a formula here that you can see displayed right here. And based on our calculations, we believe we can increase the equity, the value of the property by 8.6% per year for the first 3 years. That's our forced value add over the first 3 years, because we can raise the rents by that 30% as we increase the value cosmetically to the property as well. Of course, we have our expenses here. Landlord does pay for heat. That is one of the negatives of the building. We may switch over the utilities, but actually we did an analysis of that. It really didn't make sense to switch it over. So we'll just work that into the numbers. And of course, we have maintenance, we have reserves. The management fee there is discounted. Most management companies had around a 6 to 7% management fee. We'll be at a 4% management fee. We have legal and accounting, and of course, annual inspection, tax filing fees, all of our expenses there. About 140 or so thousand expenses. And here's our targeted returns over the first 5 years. Okay, we'll go over the target returns over the first 15, but let's start with 1 to 5 here. So over the first 3 years, we believe we can force the value of the building up. That's called forced appreciation by 8.6% per year. I just explained how we're going to do that. It's by renegotiating leases, lowering our expenses, finding out more ways to make income on the property. And of course, the rents are already 30% below market value. So I think we're going to get there. So we're confident over the first 3 years, we can increase the value by 8.6% per year. We also have natural inflation. Inflation right now is like, I don't even know. No one really knows. It's probably like 3 to 5% right now. Inflation normally is around 2%. So let's hope to God that inflation goes back down to 2% or so. And that's what we're assuming inflation is going to do. So we know there's going to be some natural appreciation, just natural market appreciation, inflation essentially of 2% per year. Okay, so we're going to take our 8% forced appreciation, right? Because that we control that. We know we can get it up by 8.6% a year. And we also know that if you look over the last 100 years, inflation takes, it's told at about 2% a year. So inflation will also likely happen at about 2% per year. So we're going to add up 8.6 plus 2. That's going to give us 10.6 total equity gain for the first 3 years. That's how we get there. Now, of course, the current markets are growing at like 8%, but we're not gonna put in a natural market growth of 8%. That would be overpromising. We don't know what the future holds. So here we have our cap rate value. Okay, so we're putting this location at a cap rate of 5%, and we're putting a cap rate value of about $2.9 million. Now the property's probably worth a little more than that off the bat, but we'll just be conservative and put it there. And then we have our debt service. Okay, and then we have our debt service getting paid out over time. but also our cap rate value growing over time. So the first 3 years, we expect a growth of about 10.6% per year. But by year 4, we're going to have executed our value add strategy. So by year 4, we'll have exhausted a lot of those maneuvers to push the value of the property up. So then we're going to go back down to a lower growth of about 4.5% a year. Okay, that 4.5% assumed growth by year 4 and going forward from that year on is because, of course, we're going to have still a little bit of forced appreciation. We're still going to be renegotiating leases higher. We're still going to be lowering our expenses and finding out more ways to efficiently run this property. But we are going to exhaust some of those large things we can do off the bat by year 4. So then we're going to drop down to about a 2.5% forced appreciation, about a 2% natural appreciation. That's going to give us about a 4.5% appreciation year over year going into years 4, 5, 6, and on. By year 5 here, we have a cash out refinance completed. That's going to give us the ability to pull out a new mortgage amount. We, of course, have a large amount of equity at the cash out refinance, and this will allow for the large lump sum to the investors of between 45 to 50% return on investment at the refinance. That is the liquidity event that our investors look forward to, that we all look forward to, and that's the main strategy with these properties. Right? The cash flow is nice, but it really is not the big money maker on these investments. The cash flow is nice because it's just enough to cover some costs and get some checks coming in, but it's not enough to get taxed on because you can write that off with the tax depreciation. Now, the refinance, that's where the real money maker is. That's where your 45 to 50% cash on cash return is realized in one shot. And that's just amazing because that's tax-free money. And the less money you have to give to the government, the more you keep. We talked about why that's tax-free. It's if you remain invested. It's if we do a 1031 tax deference down the road. And if you choose to do that, then that's all tax-free income. If you choose to exit, that's fine. You can get back your initial investment, keep the monies you earned from the cash flow, keep the monies you earned from the refinance, get back the initial investment you made. But then the IRS is going to say, hey, you invested $100,000 with People's Capital Group. You made $50,000 over 5 years, and now you have $150,000 when you exit the investment. So you need to pay taxes on that $50,000 you earned, right? So that is the ramification of exiting investment, but our investors have that exit option. Here's our years 5 to 10 chart, and I really want to point out something here. I want to talk about this 20% lease loss. So we're wrapping up here, just a couple more minutes. We'll talk about how to get started as a qualified investor. But essentially the lease loss here, 20%, that's very high. That means we're taking 20% of our net cash flow and throwing it in the garbage, assuming it's going to be exhausted on just unknowns or us trying to collect rent from tenants. Lease loss is like back due rent or like partial payments of rent. It's like rent that hasn't been paid yet, but like is to be paid, but is not collected. So it can really add up over time. Our lease loss is generally around 3 to 5%, even during this pandemic, right? Our occupancy rates generally higher than industry average, generally above 90%. Our collections are generally above around 93 to 95% collections. So really good collections, really good management of our properties. Of course, that's our specialty. So of course we have to have good collections and low vacancies, but we're going to assume that this property does worse than reality. We're going to assume a 20% lease loss, right? That's 3-4 times what we're actually executing on. So that's really important to understand that we're really conservative. We put these numbers in place, we put these targets in place, and that allows us to hit those targets year over year and do even better than targeted. Here's our 10 to 15 year chart. Again, we have a long-term view with our investors. You can stick with us to the 15-year mark where we plan on doing a 1031 tax deference and trade into a bigger building, help put your kids through college and get those things you want in life, build that IRA or build your investment, or you can exit each refinance. Of course, you have that option, but we want to predict out to 15 years. We want to show you that growth along the way because as we own the property, here's our targeted ROI for investors. You can see years 1 to 5, our targeted ROI in general is about a 12 to 13% internal rate of return, about 11% annualized cash on cash return. Years 6 to 10, it's going to grow a little bit. We're going to get up to about a 13% internal rate of return, a little bit higher, 11% cash on cash return. Years 11 to 15, it's going to grow even stronger. 15.5 internal rate of return, 13.7 cash and cash return. Our goal is to always be building, always be improving. The longer we own assets, the better they do, because the more time we have to improve it. So that's the bottom line. We want to own these assets long-term, improve them long-term, give our investors the flexibility of getting in and out of projects through those 4-year periods or so, and possibly reinvesting in other properties, okay? And again, most of our investors reinvest over time. Most of our investors choose not to exit because of the tax reasons and whatnot, and normally because we're doing better than targets. And that's a really important factor when you're searching for the right syndicate to invest your capital. Here's the equity tiers one more time. We have 5 different tiers, rewarding a higher investment. We went over that before, so we're not going to dig too much into that. If you want to review this offering on your own time, if you feel like this might be a fit for your investment goals, or you just want to follow us more closely and get the next offering that comes out, we have a 17 unit coming out in about 3 weeks. Then the process to proceed is to go to peoplescapitalgroup.com. So I'm going to show you that right here. And this is our website, peoplescapitalgroup.com. On this website, we have podcasts. You could check out the Passive Cash Flow podcast, where we've interviewed a number of people there, and we have over 50 podcast episodes. Check out our webinars. We have past recorded webinars, lots of information there. And then, of course, if you're ready to invest, you want to click this button, schedule a discovery call, and that's going to bring you to this qualification page. Now, the SEC requires us to collect a little bit of information about you, about your financial situation, about your income, about your education level, and if you're accredited or sophisticated or neither or not sure. So you want to fill out the application here the best of your ability. It's really simple to do, and then click the button that says schedule an introductory call. And that's going to prompt you then to schedule a call, the managing member of People's Capital Group. Chances are you'll be able to connect with me on that call, and I'll be able to answer all your questions and pre-qualify you further. Make sure you are qualified as either an accredited investor or a sophisticated investor, and then decide, if you're qualified, move to the next step. So then we can send you this private offering to review on your own time through a PDF that allows you to page through it at your own time, and any other information you're looking for as well. Perhaps you're a new investor that just found us on YouTube or Facebook and you don't know much about us. Well, then we can send you references. We work with over 50 investors. Most of them reinvest over time. We're happy to connect you with a few of them so you can talk with them and see what their experience is like. Or maybe you want to see our real estate owned. You want to see all the addresses we own. You want to see the debt on those addresses. We are transparent. We're willing to share this information with people that are willing to share some information with us, fill out the qualification form and get qualified. So again, fill out the qualification form, get started. We'll be able to answer your questions, see if you're a fit for our group here. We actually have more investors than opportunities. Our last opportunity funded in 7 days. So if you do want to take a look at this opportunity, even have the chance to get involved in it, you want to go to peoplescapitalgroup.com, click the button to schedule a discovery call, fill out the qualification form, get in touch with us here as soon as possible so that we can get you started on the qualification process so it doesn't feel like a rush or anything like that when you're making an important decision like investing in an asset and a syndication. And we also have options for investors to actually get started early. So if you're looking to put your capital to work sooner than later and earn an interest rate, we offer that as well. So if you want to learn about our options to earn interest rates through promissory notes, fill out the qualification form. That's something new that we're offering right now. We offer investors promissory notes so that you could invest with me and Seth. We'll personally guarantee a promissory note. We'll pay a 10% interest rate. Those interest checks will go out to the investor. And then once we close on this property, that investment will be converted into equity in the property. So that's a way that you can get invested now, start earning an interest rate on your investment, start getting checks in the mail, interest checks in the mail on your investment sooner than later. And then when we close on this property in the next 3 months or so, your investment will be converted into ownership in this property, just as the other investors' equity would be. And then you will own ownership in this property. So that's a way investors can start earning an interest on their investment right now, put the capital forward, This is an offering we're putting out to our investors. If this sounds like something that interests you, or you just want to review the offering and learn more about it, go to peoplescapitalgroup.com, fill out that qualification form, and let's get connected. Okay, I'm going to answer some questions now. So here's a question. Any annual return before the cash out refinance? Yes, Maurice, we do have the cash flow that's paid out quarterly. And we expect positive cash flow from this property by about year 2. By year 3, we're going to grow that even stronger. By year 4, we should be able to get max cash flow from the property. And of course, you have your tax depreciation at the end of the year to write off that cash flow and the cash out refinance as well. All right, so I don't see any more questions right now. But here is the offering that we had just reviewed here. And that was 27 units in Rahway, New Jersey. And we talked about all the details here, so hopefully you're able to retain all that information. If you want a copy of this webinar, then you want to email us at info@peoplescapitalgroup.com, or you can just respond to the emails you're getting for this webinar, and we can send you a copy of the recording of this webinar. It'll also be on our Facebook group as well. If you're not a member of our Facebook group, check us out, People's Capital Group on Facebook, with real estate investments as well. That's our Facebook page. And the process to proceed is to get qualified, then review this private offering, schedule the introductory call, we'll review the operating agreement, and we'll go over the details once you're qualified for the final steps to get involved in an investment. We make it easy to get qualified. We make it easy to invest. We make it enjoyable and safe to invest with People's Capital Group. So if you want to learn more, go to our website, peoplescapitalgroup.com. I put the link in the chat, so you can actually click that link in the chat to fill out the qualification form. I see more people have kind of jumped on as we're going here. I see a lot of people probably caught the second half of the presentation. So again, right back to the email or right to info People's Capital Group, or go to our Facebook group and check out the recording of this webinar so you can view it all. Or if you want to just review the PDF on your own time, go to our website, fill out the form, we'll send it over to you. That's it for now. I'm Aaron Fragnito of People's Capital Group. Thanks a lot for joining us.